wonderful to see so many faces here, and I think we've got a very, very interesting topic this morning and three excellent guests. I'm going to start at that end. Bastian, Chief Investment Officer at Prescient Asset Management, systematic investing. So very different to the other two gentlemen here today that are really active stock pickers, Leonard Creer from M&G and Jacques Plaut from Allan Gray. What's also interesting is Leonard and Jacques are two ex-colleagues. Leonard used to be a portfolio manager at Allan Gray. He's now with M&G. So Leonard, I hope you're happy sitting next to Jacques this morning.
I was saying earlier that we fight less now than when I used to be there. Yeah, so it's nice to be with Jacques again this morning.
Excellent, thank you. Now, the topic of today is very interesting. We're actually going to speak about why have asset managers not utilized the full 45% offshore allocation for Regulation 28 compliant funds. We're also going to have a look at some of the holdings of the funds from these managers and see where they are positioned and just their views around this 45% limit and whether they are currently utilizing it. Now, I've got a slide just to provide or a few slides to provide some color to this. But the new limits really been a game changer for us. When the limits changed, we at INN8, we immediately jumped into action. We rerun our optimizations. We checked what is the right number for conservative fund, the moderate fund, aggressive fund. We also spoke to a lot of the industry players, including the three gentlemen here, spoke to them and said, are you going to utilize the limits? If, why not, etc. And the interesting thing for us was that it didn't actually happen overnight that managers started increasing offshore. Now, this is a bit of a busy chart, I guess, to check very quickly, but it's really per multi-asset category, the ASISA categories, the offshore allocation at the end of May 2022, more or less the time when regulation changed, or just after that. And then the lighter blue color is the more recent offshore allocation. Now, I think the important part is, as one would expect on the income side, not really a lot of offshore. And we can dig into that, especially with Bastian that manages a lot of income funds as well, but typically brings a lot of volatility. And then as you move up the risk return profile from left to right, you see an increase in offshore. But the interesting thing is, even on average, the high equity fund category typically or currently only has just over 30% offshore. So why have these managers not utilized the full offshore or opportunity? And just one extra slide, if we look at funds that actually have more than 40% offshore exposure, these would be the funds that really went quite far in terms of the 30% limit where we started with, plus the Africa opportunity. You can see in the high equity space, the least restrictive type of portfolio, only less than 1 in 5 funds in the industry, multi-asset high equity funds, actually are more than 40% in offshore. Now, Leonard, maybe let's start with you. Why do you think that's the case?
Yeah, thanks, Rico. So it's obviously difficult to speak for an industry at large or for other managers, but I think a lot of the optimization work that we've done internally came to a very similar conclusion to that INN8 came to, in that once you start doing a portfolio optimization, you go above the 35% odd level, you start to move away from the efficient frontier. So we definitely saw that across all these various buckets that you see. I think a second reason is that typically our clients would be South African clients with rand liabilities. So a lot of the mandates, whether it would be within the unit trust space or outside, we're actually trying to solve a rand problem for the client. And then I think sort of perhaps the most important out of all of it is, certainly on our assessment, is that just the value that's on offer today is, in our opinion, excellent in South African assets. And I'm sure we'll get into a bit of that detail. But the opportunity in South African assets, whether it's risk assets, equities, bonds, or whatever, we think there are better opportunities in terms of the prospective returns offshore. So I think a lot of our colleagues would have come to or competitors have come to the same conclusion. But yeah.
Bastian, you did obviously not. You went straight to 45%, and I recall we we checked the numbers and we saw immediately, even for a defensive fund, it was very soon after the regulation changed, 45 offshore. And I think you and I might have had a call at that point. But maybe just explain your thinking, more for the industry at large, but maybe also touch on your thinking on that limit. Thanks.
Sure, good. Sure. Thanks also from my side to everybody for joining today, and thanks, Rico, for having us. So we observe exactly the same trends. So we see that a lot of the managers in South Africa haven't moved, and we observe that with our tool set on a daily basis. We know exactly where the managers are through our quantitative analysis. And so we also were puzzled. What is the reason? And the two key reasons given are A, SA assets are cheap, and B, the currency risk eventually gets too high, so you can't move the whole way to 45. At present, we think that both of these arguments are actually heavily flawed, and the reasons for that are the following. First of all, SA assets are cheap, we agree with that, but you still need to know where your long-term allocation should be in case of SA assets not being cheap. So one should separate between a strategic and a tactical asset allocation call, and we shouldn't mix them up together. And the second argument, basically the currency risk, is for us it's very important to always stress that currency risk and asset class risk are two separate things. So I agree with the currency assessment. The currency is very volatile and introduce risk, but I can hold any listed offshore assets and receive the return stream in rands. So what we do at present is we hold 45% offshore, we get the broad asset class diversification, we make use of the entire, basically much larger opportunity set, but then we manage the currency risk efficiently, and that's something which we've been doing for many, many years.
Thank you. Jacques, a very interesting question to you. You've obviously got a fairly strong...
I'll be the judge of that.
a fairly strong offshore capability, or dedicated capability as well, but do you think a lot of managers in South Africa are a little bit, or they don't have enough confidence to go high and offshore? They might not have the build up the team to explore offshore opportunities, and therefore stick to what they know and just stay overweight the South African assets.
It could be. It was definitely easier to buy what you know. But then also, I mean, we are buying offshore assets to an extent in that Glencore, Richemont, Mondi, all these shares that just happen to be listed here are offshore stocks, don't have much to do with South Africa. So I think, yeah, when you look at the numbers, sort of, we're at 37, so-and-so is at 30, you could probably add all the rand hedges to that, and then like you end up with a higher offshore exposure. But yeah, to answer your question, yes, I think that must be part of the reason. I know it's true for myself. It's much easier to buy things you know well.
Thank you. And Leonard, you also have a strong offshore team at M&G. Do you think you need a big offshore team to generate proper alpha and outperform competitors?
Look, I think it certainly helps us in terms of when we think about where this vast world of thousands of stocks and hundreds of thousands of different bonds and maturities. So it helps us definitely to have a large team. So we have over 600 investment professionals around the world, and a 7 trillion rand of assets under management in the broader group. So it's great for us to be able to tap into that expertise, but having this truly local sort of orientation towards the problem that we're solving for our clients. So we've been integrating for probably the better part of 5-6 years, more and more into the international M&G team. So for us, it's very helpful to be able to have the feet on the ground, to have the established relationships, everything regarding sustainability, investment, to have the teams that have done that work. So it's very hard to do that broad a universe in detail. Well, it's impossible. Even with 600 investment professionals, you can't do it. But the fact that our reach is so much wider and the ability to have feet on the ground, we think it gives us a great advantage in an environment where, when the opportunity and the time is right, we might go to 45%. I mean, that's the great thing, I think, about this new Reg 28 allowance, in that it's just opened up the opportunity set to move your assets around where the best opportunities are. At the moment, we don't think it's offshore, but that doesn't mean it will forever be that way.
Bastian, you probably completely agree with Leonard there, with your with your systematic approach. You probably don't have a lot of guys running that. You've got a lot of quantitative people, but you don't have guys on the ground analyzing stocks on the offshore side. What is your view on that?
Yeah, so look, I mean, we don't have guys on the ground analyzing stocks in SA even, because we don't really believe in that strategy. I mean, we do know that empirically it has been proven so many times that 90% of all stock selection processes don't succeed. So not saying that other stock selection processes generally are not working.
You're fortunate to be sitting with the two 10% here this morning.
I'm very fortunate, but look, yeah, very lucky. Indeed, I will have to say that obviously we do suffer a little bit from a home bias when we make arguments like that. Two of you probably are in the top 10%. I will probably attest that. But the reality is it is something which is tough to get right. And even if we can get it right, we have to acknowledge that the upside of getting it right is quite small, while the downside of getting it wrong is quite large. And that's what sometimes often gets forgotten. But to your point, Rico, I think more importantly, it's just not that important to get right, because we all know that more than 90% of your investment success is in fact driven by your asset allocation choices. So that's really where we concentrate our effort. We try to get the asset allocation call right. We do that globally with opening up to 45% offshore. That's a massive move for us in South Africa, not just as an asset management industry. I think it's a massive move for the South African saver. But it's an asset allocation call which now becomes more important, because we have to consider so much more than what we had to consider before that.
Excellent. And I think a good answer, given that you're outnumbered by the active managers on the stage here. But let me just move on to your holdings next. And I tried to simplify this chart. So the grey area is the local assets for each of the managers. And I'm presenting a low equity fund as well as a high equity balanced fund for each of the managers. And then above the horizontal line is the offshore allocation. And I've just split it up into three main components: cash, bonds, and equity. So offshore property, rest of Africa investments, etc., would sit in those buckets as well. Now, Jock, you can't necessarily see the screen behind you, but I know you can see there, and you know the numbers pretty well. But I think an interesting thing for me is this dynamic of having more offshore and a high equity balance fund versus Alan Gray's stable fund. Can you explain that difference and why there's such a big difference between your two portfolios at the moment?
Yes, sure. So what we're trying to do with stable, and what we've always tried to do, is not so much sort of less risky balanced fund, but more, rather than put your money in the bank, just take a little bit of equity risk. You know, the stable fund is trying not to lose money over 2 years and trying to do better than you can in a bank account. And that's a very Rand it's a Rand benchmark, right? So with stable, if we went to 45 foreign, I think that would introduce too much volatility for that client base looking to beat Rand. So my guess is sort of a neutral foreign level for stable is more like 20-25%.
And it ties up with Leonard's comment about the liabilities.
Yeah.
That's really the same point you're making there.
Yeah, so I think, just a little point on sort of when we did that optimization work last year, when this was announced, it was sort of it's not just always the return that is the only thing that is important. So we tested across a wide range of different metrics. So drawdown analysis, peak to trough, length of drawdowns. So there's a whole bunch of different ways in which you can define the risk in these kind of low equity portfolios. And everybody in this audience will know, like the client journey, and to keep them invested and keep them sort of staying the course is a problem that we as asset managers experience. It's what you probably as advisors experience, is to keep the clients motivated to stay in there. And so in the low equity space, you really want to try and think not just what's the objective in terms of the Rand liability that it tries to match, but also what is the journey for the client look like, especially in these kinds of portfolios where they typically or very often actually use these portfolios to live their pensions from. So they can't afford that time to wait in scenarios, say in high equity, where you typically think your average client has a bit of a longer time horizon.
And Leonard, while the mic's with you, you've got even less offshore than Alan Gray in your portfolios, and I know your compliance team did send you the new numbers that you can invest in, but what's happening there? Just over 30% from the balance fund, it does feel very light.
Yeah, so I think, I mean, to my earlier point, the valuations in South Africa, particularly in the bond space, but also in a lot of the local domestic SA Inc. assets, we think we're finding exceptional value. And when we then have the conversations with our offshore colleagues and we sit and we compare apples with apples, there is just a massive difference. And one of the other points that Jacques also alluded to earlier is in a lot of these Rand hedge stocks, we've looked at them and their peers for many, many years. And so we compare, say, a Richemont against Louis Vuitton, as an example, and ABI against a Heineken. And, I mean, this is debatable, but sort of where we sit at the moment is we think a lot of these multinational stocks that are just happen to be listed here, they're actually cheaper than their peers. So it comes up in your portfolio as a local asset, but actually it's offshore and we think it's better value.
It's a strange coincidence, because it's not only against the peers, it's just in absolute terms. You look at the Glencore, Mondi, maybe even quite a big proportion of the ones here, they just screen really well against global
Against the
indices.
competitors, yeah.
You can buy Glencore on 10 times free cash flow or Apple on like 38 times or more. It sort of seems like there's good value in those stocks, and just there's no reason why that should be, but it feels like it happens to be the case.
I think that's right.
And Jacques, that integration you're talking about, you and Leonard have been speaking about, how important is that? We often hear examples from yourself and other active managers that you don't have to buy Sasol. You can buy a foreign oil or chemicals company. You don't have to buy AB InBev. You can buy Heineken. How important is that approach in this new world where you can go 45% offshore?
So more options are good. It's good to have more things to choose from. I still think many of the cheaper ones happen to be listed here, but yeah, it's good to have that extra flexibility for sure.
Bastian, you obviously can't do that in your systematic approach on equities. Do you think you're leaving performance on the table by not having that option of integrating assets? You're getting all the tough questions today.
Right, that's an easy one. Just we'll reply. We generally look at the numbers, and if you look at the numbers, the answer is no. So, and I must also argue. I mean, obviously, I'm a bit out, like 1 against 2 here. But the reality is, I find it hard to believe that. I mean, how many listed shares do we have in SA, and how many of those are actually investable for funds of an M&G or Alan Gray balanced fund? I mean, the universe shrinks to 40, 50 shares,
Like
not
100.
much more. And if you look globally, I mean, the MSCI World has almost 2,000 shares. The MSCI Emerging Markets has almost 2,000 shares. So that alone is a universe of 4,000 shares. I can look into the Russell 3000. They've got 3,000 shares in the States. So we also agree that SA assets seem starkly undervalued, particularly now. But it's very hard to believe that with this vast opportunity set globally of almost 10,000 shares, which I can pick, that the most attractive ones are the 40 ones listed in SA. That is hard for me to believe. I will say that.
Some good points there. And Bastian, you spoke earlier about then rather being active. That's where you think a lot of the alpha and outperformance comes from. Can you give us a few examples of how you are active in that 45% allocation of yours on your balance fund?
So that's a very good point and important for me to get across. Like not stock picking doesn't mean passive. I mentioned earlier 90% of your investment success is driven by asset allocation. That's why we're highly active in this space and where we should be active. Okay, so that's just very, very key to understand. How do we manage the currency exposure? Well, as said, we don't mix SAA and TAA, so we know how much how much of our exposure should strategically be offshore. We think it's 45%. We think we should have far less currency risk. Strategically, we think about 25, 30%, which is in line with Leonard's optimizations. If you are able to split the currency risk and the asset class exposure in your optimizations, you will get to 45%, by the way. And currency risk, yes, exactly there, 30%. And an example would be then to manage the currency risk individually. So I have 45%, we at present can have 45% offshore, but have much less currency exposure. I'll give you an example. Nothing stops me from having tech exposure globally. Like we prefer to have broad index-based tech exposure to Apple, Amazon, Google, Microsoft, instead of just having Tencent exposure or Naspers exposure and saying I've got global tech exposure. Two different things. I can look into the banking sector. I can say I've got already Standard Bank and I've got already NetGroup. Some of them might operate globally. Well, I rather have JP Morgan, Goldman, and all of those shares globally. So I think it's very tough to pick shares individually, but I think having that broad exposure to all of these names long term is absolutely crucial.
I think the one point that I wanted to make, just on, it's back to your initial questions. I as a multi-asset portfolio manager that is investing domestically and with an offshore component, I place a very high value on the ability to have a full holistic view of the overall portfolio. So to know, to say Bastian's point, that I already have, say, a large position in Naspers, so I have some tech exposure, or I have Standard Bank, and then because I also manage the offshore component within this solution, I complement what I pick offshore and how I build the portfolio with that, with this overlay of your valuation, currency, and overall portfolio construction considerations.
Can I say one thing? There isn't, Leonard, just a question then. I mean, we all know the Black Litterman model, which is a very humble model, which basically starts by backing out expected returns, long-term expected returns, by looking at market cap. And the reality is in South Africa, we are less than 1% of global market cap, less than 1%. And any global investor can invest in SA. So exchange controls don't matter here. Any global investor can invest in SA. Yet we have less than 1% global market cap. There's a reason for that. So what Fisher Black and Robert Litterman would probably tell you is maybe your starting point should be different. Okay, why does the starting point have to be I've got X, Y, Z in terms of Naspers exposure? And that's why we're saying, like, with this 45% allowance, can we not take that step and say, how would my portfolio look if it can be truly global? And then you probably should have less SA exposure, given that it is such a concentrated market.
No, I think it's a good point, but I think one mustn't make the assumption that your domestic is your inherit, and then you supplement that. I didn't want to create, it's a chicken and egg. That's why I made the point that it's so important that it's holistic. You need to look at it all simultaneously. Sorry, I didn't want to create the perception that I have this, and now I just supplement the offshore.
And Jacques, just to jump to another point, fees in South Africa. Typically, offshore exposure costs more from a South Africa, in SA or rand-denominated funds. What's your thoughts? As offshore is becoming more and more expensive, do you think South African investors are going to have to pay more for their portfolios with higher offshore? Do you think asset managers like yourself can keep costs consistent with higher offshore?
Well, costs and fees are different. Well, I guess our costs are different, but so I'm really not sure how that's going to land. I mean, it's competitive out there, and people pay for performance. I do think there's some benefit to a client to not having building blocks. Like, so if you have one person doing the asset allocation in a balanced fund, I think you're getting a bit more than if you're buying the individual solutions. Okay. That's kind of all I really have to say about that.
Yeah. Perfect. Leonard, you can't have a panel discussion these days without touching on AI. M&G uses you use some AI capabilities. Maybe just 1 minute quickly on what you're doing on AI on the foreign side.
Okay. So I mean, you're right. It is a bit of a buzzword, and it's not something new to us. I mean, the team actually started in Cape Town. It's about 10 years ago now, in thinking. And you're talking, we do some of the machine learning stuff on the SA portfolios as well, but particularly on the offshore, because that's where your question pertains to, is what we've effectively tried to solve for is, sort of with M&G, really our tagline is to get this consistency of the client experience over time. And how do you do that and replicate that offshore relative to a world index that's got 6,000 stocks? And actually, you want to be a stock picker, but you don't want to have that volatility that some other asset managers. So really a systematic quant-like driven process that is incredibly data intensive. And with the evolution of computing power and AI models, the sort of the non-linear statistical relationships that you're now able to test and essentially come up with an optimized stock portfolio for your offshore component. That's really where we deploy it, and subsequently have that human overlay, those feet on the ground, that on-the-ground knowledge, that sustainability angle as overlays on top of this quantometric process. And that product is now on its 4th version, and it's a core building block across all our equities, whether you look at equities on its own, whether you look in these multi-asset portfolios, and it really solves and keeps that philosophy of having the consistent returns for clients with an increased offshore exposure embedded in our local portfolio. So it really works well for us.
So we're running out of time quite quickly, and I've got 100 more questions I would love to ask you guys. But I think the final question, and I ask you to bring your crystal balls from Cape Town. Over the next 5 to 10 years, Bastian, starting with you, just 30 seconds, what's going to outperform, in your view, SA assets or global assets?
Before I give you that answer, I want to say very refreshing to hear that it is joining the AI consideration after stepping out of the stock picking world with Alan Gray previously. Well, that's a good move. You're on the right track. To answer your question, I think it's a very good question. I actually think, and we at Prescient model long-term expected returns through also like a risk premium approach. We think there's a lot of reasons to believe that SA assets will outperform, which might be contradictory to the 45% which you can see on the screen. I think I've given some reason why that's not necessarily contradictory. And the key consideration here, it's not just about which asset class is going to outperform. I think SA assets will outperform because they're much cheaper. There's so much negativity in this country around our own country. Only the rugby gets us excited. Otherwise, we're always negative. With that, I think there's a lot of undervaluation of our asset classes. But the question, Rico, should be bigger. It's not just about which asset class outperforms. It's about correlations, it's about risks, it's about separating currencies from asset classes. It's about much more, because this whole investment world for us in South Africa has gotten much more complex with this 45% offshore allowance.
Leonard, you've got 10 seconds on that one after Bastian.
Yeah, so I think our portfolios reflect, I think South Africa will do better, but I think that's sort of part of the greater world where I think emerging markets generally and emerging market equities will do better on a 5-year plus view.
Jock, your thoughts on...
I'm going to go on further. Frontier. We have a frontier fund actually, which is Vietnam, Georgia. That would be my bet. If I can choose. I don't know if that answers your question, but that's the one I would choose.
No, that's an interesting answer. Thank you. Thanks a lot. We've pretty much run out of time. I've taken down 3 key points I've gotten from this panel. Firstly, it's not as easy as just investing 45% offshore. I think there's much more to it than just going 45% risk profiles of clients. Bastian's talking about hedging liabilities, etc., of clients that will retire in South Africa. The other point, being active is key. Whether it's stock picking, asset allocation, you can't just sit with a very dull portfolio. And then the last one, I think from our perspective, we blend these 3 managers in our DFM solution. Excellent managers, we get diversifying view, and we think that's exactly the right approach, to blend these various views and to achieve the client objectives. So thank you very much, guys.
INN8 is a registered trademark of Stanlib Wealth Management Pty Limited, an authorized financial services provider.